I think is all we can say.
Yes, indeed. The exclamation there is quite apt this time around. I think a lot of people, because of what has happened with the June inflation numbers and the print that came out yesterday, they were expecting such that there would be a halt, a pause, just like we're expecting a pause in the U.S. and many other central banks in Africa and around the world. But just one thing that actually stuck out for me, and I spoke about it at the previous meeting that I was able to be here for in March, saying that the Reserve Bank governor hasn't said much for at least a year. At the time, he hadn't said anything about the monetary policy. Now it's time for the government to do something. He came out quite strongly this time around, and for him to say that there are other tools that could be used, and he's been saying this. He has been saying this to say that there are other tools that could be used to deal with inflation. And what we should be aware of now is that the Secretary General of the ANC, Fikile Mbalula, said he's going to have some discussion and engagement with the Minister of Finance. Nothing is going to happen with that. It won't go anywhere. Basically, what Lester Kganyago is saying is that he's giving the ball again back to government to say, manage public debt. We've seen public debt since 2000 going from 40% to currently in 70.9% debt to nominal GDP. We've seen the load shedding. So he is saying the mechanisms that they are using right now, using the tool of interest rate hikes to manage inflation, is not going to last forever. We need to deal with this right now in terms of government taking the steering wheel now to make sure that public debt is dealt with. I'm glad that we are here. But what's scary is that we are likely to see more interest rate hikes in the future if inflation doesn't come down.
Arthur Kamp is the Chief Economist at Sanlam Investments. Arthur, good afternoon to you. What did you read from the Reserve Bank Governor's statement when he said and refused to rule out that this is the end of the interest rate hiking cycle?
Yes, I think the Governor is still very concerned about certain risks, and he mentioned those throughout his presentation this afternoon. Two of them stand out. What we, as just discussed, is government finance. So in the long term, a very high level of government debt. If that debt level were to continue going upwards, you can look through history. Some of the sort of worst inflation episodes in history have their root in fiscal policy that stays too loose for too long. So that is one concern. But another concern that came out was during the governor's Camdesis lecture at the IMF recently, he made this point that, as we grow and as we invest, we run a current account deficit, which means that needs to be funded. And if we don't get sufficient funding for that, and there is a risk in an environment of heightened geopolitical tension, that we don't get sufficient capital inflows, and also in an environment where global risk appetite could wane, and increased global risks could lead to less capital flows to South Africa. And then you'd get this ongoing weakness in the currency, which feeds back into inflation. So I think the governor's got a lot of these potential risks in the background that he's concerned about. Having said that, I do think that if the inflation trajectory pans out, and certainly against the backdrop of very weak growth, that this may still be the top of the interest rate hiking cycle. But it's fair that the governor says, look, I can't rule out further interest rate hikes and things will be data dependent.
Arthur, it seems like he was saying when it comes to the inflation, it's expected, as he said, to return to the midpoint range, 4.5%, somewhere in the third quarter of 2025. And basically, from what I read there, we shouldn't expect any interest rate reprieve between now and then. Am I wrong to say that? Because he did spend a majority of this particular discussion and announcement talking about inflation and its risks.
I think that's a very fair comment. I think if if the next move in interest rates were going to be down, we're going to wait quite a long time for that to happen. That's the first point, simply because inflation, as you've indicated, only gets back to within the inflation, or where the implied inflation target is, or the effective inflation target is, at 4.5% by the second half of 2025. That's a long way out. Having said that, I do think that one thing that central banks, not just our central bank, but central banks globally, can have a think about is, perhaps this is in an environment where we can sort of guide inflation back towards where we would like it to be over a longer period of time, as opposed to continuously hiking interest rates and risking doing too much damage to economies in the near term. But of course, it's very difficult to figure out exactly how much you should tighten and how much is enough. But overall, I think the comment is very fair that, even if this is the top of the interest rate hiking cycle, we're going to be waiting for quite a while for the first interest rate cut.
What do you read from what you are saying about the fact that South Africa's external financing needs are going to rise, but we are expecting a current account deficit of 1.9% in 2023? This is something that is quite interesting, because you recently wrote, actually yesterday you wrote, that the bank's concerns around developments on the balance of payments is still something that we have to consider, because it seems like inflation risk is skewed on the upside.
That's absolutely right. I think the balance of payments is key here. The unfortunate thing is that we've seen a declining level of net foreign capital inflows relative to GDP since around 2014, 2015. There was a sharp decline during the pandemic that probably was accentuated, and it's turned positive again, but only slightly so. And the concern here is that if the current account deficit were to widen, as the Reserve Bank indicates, to 2.9% next year and 3.3% in 2025, the current level of capital inflows that we've been seeing is not enough to cover that. And so either you run down your foreign exchange reserves, which is not a strategy I think we will follow. We don't have that many reserves anyway to be able to fund a current account deficit of that size for a sustained period of time. So if that doesn't happen, the currency weakens, and obviously it's already fairly weak. It's fallen a long way already. That already in this cycle has caused some upward pressure on inflation. And if it were to continue weakening on a sustained basis, we're a small open economy. The currency plays a key role in the inflation process. We risk getting into a sustained inflation problem. And so it's all about those capital flows. And why do I think the interesting point is that the bank is indicating a widening current account deficit. And I think it's doing that because we need infrastructure. And for infrastructure, you must invest. And when you invest, you typically are going to be running that current account deficit because we don't have enough savings of our own. And then we need to supplement that, our domestic savings, to get that investment done. So I think that's why they are showing that widening current account deficit. But we will need to do something to attract capital flows. And the thing to do is obviously to put the right policies in place, the right infrastructure in place, so that it raises the potential growth rate of capital, potential return on capital invested in South Africa to attract that capital. At this point, though, a widening current account deficit like that against the kind of capital inflows that we've been seeing, is a concern, because without additional capital inflows, that is a risk for the currency. And I think that's what the governor is alluding to.
Arthur, there's huge concerns around food price inflation. If I heard the governor correctly, they're expecting food price inflation this year, for the calendar year, I presume, of 2023, to be 10.3% and then 5.2% next year. If you look at this year and what's happened to food prices, I suppose really since the Russian invasion of Ukraine, it's had such a big impact. Is there any prospect? I mean, do you think we're still 6 months away from food price inflation at least, moderating? Still, I think it's driving some people, frankly, to despair at the moment.
It's an important point, because the lower income groups in South Africa, their basket of consumption goods is heavily skewed towards food prices, and the inflation rate is a lot higher than higher income earners. And also, in double digits year on year, that's quite a smack on food prices. I do think that food price inflation will slow. There'll still be inflation. Prices will still go up, unfortunately, but at a slower rate. if you look at some of the leading indicators at producer level, that does tend to suggest that those price pressures are beginning to fade. But the risk here, and the governor alluded to it, is that adverse weather conditions, could potentially result in renewed pressure on food prices and production going forward, but we'll have to wait and see whether that's the case. So, yeah, unfortunately, if food prices are going to remain elevated, and unfortunately the best we can say is that prices are going to keep going up but at a slower pace. This is a problem for our lower income earners, clearly. And it does put the onus on the Reserve Bank to, this is where the currency is also particularly important, because ongoing weakness of the currency, which increases production costs, including fuel costs, which is important for our transport and for our agricultural sector, and also feeds directly into higher imported food prices. All of that obviously implies that a steadier currency is better, and consistent weakening of the currency sort of works against us in this instance.
Arthur, Reserve Bank forecasts have been off for some time, particularly when it comes to GDP, particularly when you look at South Africa's case. There is a revision upwards now for the global economy, up from 2.4 to 2.5%, and also here at home from 0.3 to 0.4%. But we just heard recently from Fitch Ratings Agency saying that it's zero real GDP growth that they expect in 2023. What is your view on these forecasts that have been revised upwards? Can we honestly say that we can see the global economy activity reaching those levels, and locally as well?
I think that what we have globally is some risks building. Monetary policy works with a lag. We've seen quite a bit of monetary policy tightening in developed markets. We've also seen China continues to grow, but probably the data there and lately has been a bit disappointing relative to expectations. So globally, if the economy grows at around 2.5% this year, let's say 2% next year, maybe a bit more, that's not especially strong. It's at least it's some growth, but it's not especially strong relative to the longer-term trends. In fact, in South Africa's case as well, if you're talking about 0.4% marginal upward revision to the forecast, these numbers are not environments within which you get strong employment growth, and are not environments that you would ordinarily look towards having buoyant commodity prices, which can feed back. Or upward revisions to commodity price forecasts, which would feed back through into South Africa positively. So, these growth numbers that we're looking at are hardly exciting. 0.4% for us is not going to do anything for our employment situation, which is our biggest problem. And in fact, at 0.4%, it causes all sorts of other issues as well. One of those, of course, is question marks behind how does government revenue hold up, and how does that feed back through into budget balances and fiscal policy, which the governor also alluded to as being important. Again, it comes back to our point. In the long term, fiscal policy is also important for the inflation outlook.
Arthur Kamp, thank you very much indeed. Really do appreciate it. Chief Economist at Sanlam Investments. Kalani Mbandra, our business editor, with us as well here. Of course, in a moment, our business reporter, Ntokozo Khumalo, she's in the briefing. We'll get a live update from her as our question and answer session at the headquarters of the South African Reserve Bank in Tshwane continues.